Hello, clients and friends of MBP Sterling Partners. It's Jamie. I'm broadcasting to you from our virtual AI created office, and I'm here with a Q4 2025 outlook. Hopefully, you've just watched our recap of 2024 year to date. If you haven't, it's the video immediately preceding this in your video feed. So let's get into it. Let's jump in. Here's our agenda for today. We're going to look at themes in the market. We're going to look at interest rates. Then we're going to have a discussion about market enthusiasm. Our themes for 2025, we've explained before, and we'll go through them again just very briefly. We've had lots of policy volatility. We've had interest rates higher and lower, depending on which end of the yield curve you're looking at. Tariffs, immigration, and fiscal deregulation has been fast and furious. The country focus is yet to be determined, but international is winning the year so far. And many of our investment themes came true, but the hydrocarbon-based energy, meaning oil and gas, did not. With rate expectations, the Federal Reserve and the Bank of Canada were both cutting rates this year. The expectations are for a couple more cuts out of the Fed, but it looks like Canada is done, and Tiff Macklin have said so much. So we're not expecting any lower rates in Canada unless the data points to that, whereas in the US, we should see a couple more cuts between now and the end of the cycle. Getting into the enthusiasm in the market, let's have a look at the sectors that have outperformed versus underperformed according to the Goldman Sachs baskets. Non-profitable tech, high beta momentum long, high retail sentiment. These are sectors that retail likes to go after, and an enthusiastic and risk-taking retail investors push them higher. Sectors with high oil input costs, high floating rate debt, and low profitability small cap, which investors aren't very enthusiastic about at the best of times, they're the losers. Trailing 3-year returns for the major averages are also very strong. And of course, when you see them trend above the average trend line for so long, some mean reversion is to be expected. So this would suggest to us that sometime in the future, we are going to have some sort of correction or bear market that brings us back to the long-term averages. Previous instances where we've seen 3-year trailing returns as high as they are now are 2021, 2014, 11, and then of course 07 and 99, 2000, where we saw those really strong markets that had subsequent bear markets. So this isn't a prediction, but mean reversion is a real thing. So the question is, why is sentiment so bad? The U-Michigan Sentiment Index has plummeted to lows we haven't really seen since 2008, and even lower than that. So why are consumers feeling so bad about themselves? Normally, we've seen stock market returns decline a lot, which prompts these drops in U-Michigan sentiment, as you can see on the chart here. But we haven't seen those drops in the market, and yet sentiment is really bad. So that's one of the big questions for this market and for our outlook now is, why is sentiment so weak? Is it political? Is it something else? Is it the K-shaped economy that everybody keeps blaming? That is a big question that we have left to answer. One of the reasons we think that sentiment is really bad is because inflation is in a new level. We had gotten used to inflation being sort of between 0 and 2% in that channel. And now after the inflationary episode of 2021 and 2, we've seen inflation bottom out at about 2%, and it actually has ticked a little bit higher lately. So perhaps a new inflationary world, which most people hate, is driving sentiment lower. It certainly could be government spending, although we would have posited that government spending makes people happier, not less happy. But you can see here the trends for Canadian and US budget deficits continues to go lower, and the 10-year moving average here in the orange line, it really continues to push lower. This can no longer be blamed on COVID. The governments are just spending more money than they ever had in the past relative to how much tax revenues they're bringing in. The big question we have to look at is, so is this a bubble? And we're seeing strong arguments on both sides, but let's go through some of the arguments for and against. Supporting the bubble argument, we've got historical extreme valuations, so price earnings, cyclically adjusted price earnings, market cap to GDP ratios, they're all high. We've got extreme market concentration, so the Magnificent 10, whether we're using Magnificent 7, 8, or 10, they are at a huge concentration of the S&P 500, over 40%, and that means the breadth in the market is really poor. So while some companies are doing well, the average company is not. We've seen Quite a bit of speculative investor behavior. Margin debt seems somewhat high. The put call ratio seems low. And we are seeing lots of speculative behavior and lots of speculative behavior outside the markets as well. We've noticed that prediction markets and sports betting are having huge uprises as they are legalized and put online across many jurisdictions. With Canada specifically, the systemic risk in housing, the household debt to GDP ratio in Canada is still extraordinarily high. And we all know we've got a mortgage renewal wall that has started now and extends through the first half of 2026, where a substantial portion of Canada's mortgages will renew from a lower rate to a higher rate. And then, of course, we've got warnings from some of our market leaders. David Solomon at Goldman Sachs and Ted Pick from Morgan Stanley have both issued warnings that they think investors have gotten a little bit too speculative. So looking at those charts supporting the bubble, you can see that on the top left here, major regions price earnings ratios. You can see the US and to a lesser extent emerging markets are at the high end of their charts, but the rest of the world doesn't seem to be. Japan, Canada in particular is actually trading towards the low end of its range. And international developed, even though it's the high end of its range, is a substantially lower price earnings ratio than the US. Similar chart in the middle, but just for the US and the S&P 500, you can see the orange line is the price earnings ratio, and it's reaching the top of the ranges that it normally gets to. There is generally mean reversion amongst price earnings ratios, so that does worry us a little bit. And of course, the top right here, the concentration up to 40% of the S&P 500 being represented by just 10 companies is causing market breadth, which is in the bottom chart here, to break down. So this advance has become fragile. Not as many companies are participating in the advance, so that is always a concern. So the spending around AI in particular from these hyperscaling companies amounts to a huge amount of dollars that is going into just hyperscaling and spending on AI and AI related infrastructure. So data centers and chipsets, $330 billion is more than the GDP of 2/3 of the countries in the world. And this is the planned spend from these big six companies on AI in the coming years. So this is something where this concentration of dollars being spent, should it be unwound or just even normalized, could have a negative effect on the rest of the economy, not just on the AI sector. So back to our counter arguments. This is not 2000. Earnings growth is strong. These companies have amazing cash flows, and PE ratios aren't even close to where they were in 2000. We're not seeing new metrics like price per click or price per web page visit being used to justify really high prices. The prices amongst these magnificent 10 are elevated for sure, the price earnings, but they don't feel bubbly, and they've shown to have some growth to substantiate those high valuations. We've got supportive macroeconomic policy. The twin engines of monetary and fiscal policy are both in a tailwind to investors right now. So central banks are cutting and governments are spending. This is generally good for markets. The AI revolution could genuinely be amazing for productivity and costs of companies. So not just the buildup and the spend, which is economically positive, but the benefits that AI could bring a lot of companies are genuinely something that could send us into a somewhat new world of valuations where costs are less and margins are much higher for publicly traded companies. And on to Canada specifically, Canadian market is actually fairly valued, as we saw on the chart there. The TSX price earnings ratio is about 16. That's right in line with historical averages. And there's still a healthy amount of earnings growth built into the prices of the market. So that is supportive of a strong market and certainly not supportive of a bubble. And lastly, much like it's not 2000, nor is this 2008, we don't see any systemic financial stability problems. We don't see any negative debt spirals or anything systemic that could infect the rest of the market and bring down other things along with it. So these charts against the bubbles, as you can see top left, the margin debt relative to the size of the market is not very high. In fact, it's quite low. So perhaps there's not a lot of margin being taken out in the market compared to previous cycles. In terms of valuations in the top right, we're comparing Cisco from the original dot-com boom back in 2000 to NVIDIA today. And you can see that the valuation rose right along with the price on Cisco. And that was pure expectations of future earnings driving Cisco's higher, not current earnings. Whereas with NVIDIA, the price earnings has stayed relatively constant for the last couple of years. So the earnings are actually increasing as NVIDIA's price goes higher and higher and higher. And the expectations of future earnings are just for them to remain the same as opposed to grow substantially. That became increasingly hard to justify for Cisco. Canada's valuations is in the bottom right here. We spoke about that briefly. And of course, there's the earnings growth. Earnings growth is expected to be and has been robust for all sectors of the S&P 500, save for energy, which you can see in the declining there. So healthy earnings growth is supportive of a good market, and these are real earnings, not anything that's being manufactured. That is usually the hallmark of a bubble, is some fancy accounting that gets aggressive in terms of how future earnings are realized.
What are our conclusions here? You'll notice that all the pro bubble arguments revolve around big tech and AI spend, and all the con bubble arguments are for the broader markets as a whole. So that leads us to believe that the speculative excess is somewhat contained. And what we worry about is that speculation and certainly all the spend around AI and all the money that has flowed to these mega cap companies that are doing the large amount of capex or receiving this huge capex around artificial intelligence, as that capex normalizes, that it will bring down the rest of the economy and the rest of the market with it. So we do remain cautious, and we have noted that in previous drawdowns, whether it be a correction like we had in March and April of 2025 or the bear market that we saw in 2022, those mega cap names suffered some pretty big drawdowns that frankly we would rather steer clear of. So our answer, as always, is to stay disciplined and diversified in our approach. There are parts of the cycle where that doesn't feel good to do, but over cycle, it definitely is always the answer. We'd also point out that diversifying by geography has become more important because we've seen some disintermediation of trade, to put it mildly, and some different investor flows as to where they want to put their dollars to work. So as always, diversification remains our answer. Risk management is always foremost for us to manage portfolios. And even though we are seeing some signs of speculative excess, we are comfortable to cautiously watch as this expansion cycle continues on. So thanks for joining me today. We will be back shortly with a 2026 outlook. We're going to pick some themes and some possible areas that are going to be of interest for 2026. And we will have, of course, a look back on the year that was 2025. We got 6 weeks left to go. So I hope everybody enjoys their November, and we will speak to everybody soon.